Okay, so we now move into our third session for the day, which will take us into the first break and a chance to share what you've already gleaned from these sessions. We're flipping from Aussie equities to fixed interest, and asset classes gained increasing interest. Bonds are back into the conversation that starts right here today. We're going to be joined by Tim Hext, Chris West, Chris Lioutas and Michael Frearson. Now, Tim's been at Pendal for the last 7 years of his 30-year career, where he's currently head of government bond strategies. He's also worked at New South Wales Treasury Corporation, Deutsche Bank, and of course at everyone's and BT's favourite bank, Westpac. Our first Chris for this session, Chris West, is co-founder and principal consultant at Context Capital, and like Cameron is a proud sand groper from the mighty People's Republic of Western Australia. Prior to Context, Chris was running award-winning teams and strategies at WA Super across conservative strategies, but also covering international equities. So he's a man of many talents. Followed by the similarly talented second Chris for our session today, Chris Lioutas, who's known to many of us in his role as CEO and owner of Insight Investment Consultants. Chris has worked with financial advisors, licensees and fund managers all of his career, and has researched managed funds, listed securities and hybrids, as well as covering economics, geopolitics and asset allocation for his many clients. Michael is head of fixed income at Real Asset Management. I'll finish my bit, Toby, and then you can do yours. Michael is head of fixed income at Real Asset Management, so clearly bang on topic for this panel today. He has a background in managed accounts at Macquarie and over 12 years experience as a portfolio manager with a strong lean towards fixed interest and credit investments. So in good hands, ladies and gentlemen, enjoy and learn.
Thanks everyone. I'm the host of the panel, so my name's Tim Hext. I was going to do some introductions, but they've already been done, so that saves me some time, which is great. So I was just listening to panel before, and I never thought I'd be following an equity panel which said, are equities too optimistic? Normally, I don't need that. We've got no slides. You'll be happy to know. Equities too optimistic. And when I did that, I quickly looked up on my phone, how much have they gone up this year? Obviously, if they're optimistic, they must be on fire, and they're up 3%. So I think that title sets the tone a little bit, that people are worried about the economy. So on the panel today, we're going to look at the fact that bonds are back. How do I know that bonds are back? Well, we are the primetime panel. The 9:15 slot, if you're not aware, is widely considered to be the headline slot. And we do thank the equity guys for warming up and being our backup. We don't normally get this slot, so obviously bonds are back. People are focused on them. That's one thing to note. The second thing to note is bonds are actually back because, when I look at what I do, which is government bonds within fixed income, normally that is, as someone once kindly described it to me, the boring end of the boring asset class. And people don't really want to hear from you. Well, the last 3.5 years have been anything but boring. In fact, I'm going to use a word I don't often use in relation to markets. They've been exciting. And the second thing which tells me that bonds are back is the fact that right now people are allocating heavily towards the sector. And how do we know this? We know it from data. APRA released the industry fund data recently, which showed that in the last 12 months, industry funds have increased their allocation from 15 to 20%. Now, you might think 5% is not a huge deal. Industry funds manage over $1 trillion, which tells me that over 50 billion has gone into fixed income in the last 12 months. And I imagine if we took a survey around this room, which I won't, but if we did, we could probably throw in a lot more billions behind that. So we are seeing flows into the sector, which gives us a good launching pad. Now, clearly the economy is front and centre of people's minds. We all know bonds are a defensive asset class, so perhaps that reflects concerns about the economy. But it also obviously shows that the second role that fixed income does, which is to give you good income, is well and truly back. I've been out there in 2019 when bonds were 1.5%, telling investors, get on board. Was a pretty hollow story, but at 4% plus, it's a far more interesting story. So I'm joined, as we've already been introduced, by these three gentlemen to shed some light on that. And I thought I might start by asking the investment consulting crew. So I'll use, if I can use Chris W and Chris L, just to make it sound a little bit more personal than the full name. I might start with Chris W. Chris, you obviously run your own investment consulting firm. You've also been a CIO overseeing a very large portfolio over there at WA Super. How do you usually frame fixed income to clients, and particularly focused on where we are at the moment in the cycle, how are you talking about fixed income with clients?
Well, thanks, Tim, and thanks, everyone. Hopefully we don't take you too far away from morning tea. We're in a fortunate position, just like Chris here, where we get to see a whole different spectrum of flavours of advice firms that we get to partner with, and so each engagement ends up a little bit unique, right? But I just want to give you this thought experiment, right? So if you're designing the role of fixed income, you first need to think about what your overall portfolio is trying to achieve. Right? So the really simple one is to go, okay, so I might give advice through a lens of, maybe a compliance-focused or risk profile-focused advice delivery, and I'll have a conservative, moderate, balanced growth, high growth, right? I might have that. The actual role of fixed income in each of those portfolios can be thought of differently. Because if you're thinking about your conservative investor, and this is kind of the interesting thing that hopefully lots of people have learnt through, if you just sort of blindly follow an index or something like that. So if you look at that conservative investor, what does the conservative investor want out of the fixed income? Well, firstly, it's going to end up a lot of the portfolio. So what we probably want is something like capital stability. We probably want a lot of income. So therefore, its role is capital stability and income, and what we put in the portfolio should then also meet that. Right? That seems rather intuitive, but and fortunately now there are so many different tools you can do it. As you go up the risk spectrum, the higher risk you go, the role can actually change. All right, so if you're talking about a portfolio that has 90% equities, having capital stability and income for 5% doesn't really make much sense. So instead, what we'd think about is going, I think Cam was talking about some scenarios earlier, we might want to be capital efficient with that, so you actually want it to be downside protection. So rather than what you'd often see in first order thinking is to have these fixed income portfolios that end up going pretty much sort of the same configuration depending on risk profile. We think one of the best things most investors, when they're looking for their, giving offerings to their clients, is to actually go, what's the role of each piece of my portfolio in terms of achieving the overall objective, and what's the best way to do that? And an easy example here is at conservative end, it's more about capital stability and income, and at the riskier end, it's more about downside protection. So therefore, build a portfolio of fixed income that does that, which is pretty easy to do in theory.
Yeah, and just in terms of rates having gone up as much as they have you seen a pickup from your clients looking to allocate towards fixed interest?
So I'd say there's two pieces of that. One is when we started, I think interested to get Chris's experience on this as well, having done this a bit longer than we have. But when we started, people probably hadn't spent much time talking about fixed income or bonds with their clients. But now it's sort of become a really common thing that they talk about or get asked about. So that's one piece. The other side is in today's environment, and you can think about a different lens, right? So a different advice firm might give advice through the lens of a bucketing strategy or some sort of liability matching approach, right? So you can think about they might have a short-term portfolio, a medium-term portfolio, long-term portfolio, or they might go cash for 2 years, some sort of medium-term allocation, and then a growth year allocation at the end. Where the increase in yields is and potential return in the broader fixed income universe, if we want to get a debate, I reckon we get these two guys to discuss what is and isn't fixed income. But if you go to that broader universe, you can think about if you're looking at sort of a particular horizon and looking to narrow the range of outcomes, you're now talking about things that are not in the equity part of the capital structure that might be getting 6, 7, 8, 9%. So you've got other options there. There are other tools in the toolkit to be able to deliver the outcome you want for clients, which is a good position.
We'll definitely be exploring some of those, even though I prefer the lower end. Chris L., how do you see fixed income when you're advising clients, and has anything changed in the last 12 months?
Yeah, I'm still trying to cope with your comment about bonds being exciting again. I don't know if that's worrying from a bond manager or opportunity. So I think, extending from what Chris said, I think the other thing we look at, not just from a risk profile perspective in terms of which bond you use, but also from a client subset perspective. So what we find is our clients' education on bonds is varying and very different, and their experiences are very different. And so we can sit there and tell them that it must be this way and not account for any of that. But the problem with that is that it doesn't account for what they're trying to achieve. And so it comes back to how you want to carve it up. So the way we carve it up is similar to the way Chris talked about. It can either be risk profile based or it can be based on their experiences and the type of clients they have. So if their client subset is all pensioners, that's a very different portfolio. If their client subset's all accumulated, it's a very different portfolio. If historically they've mostly been predominantly passive, that's a very different conversation. But then how do we include parts of active? Where do we include active? So we actually sit there and spend time with them in the outset, a lot of time early on, when we onboard them, about where they've been, what they're trying to achieve, and where are the pitfalls. And so it ends up being a full education process from day one through what they're trying to get out of that part of the portfolio. And then we can then match it to whatever we need to, whether it's risk profile based, goals based, outcomes based, whatever you take it. But it's critical that we understand the problems they've had or what they're trying to solve for. And if we can get a feel around that, then we can solve for those. And what that generally does mean is different funds for different clients. I can pick 3 or 4 funds today that could be broadly used for all clients. The problem with some of those funds is at certain points in the cycle, that I know that client or these 2 or 3 clients, they'll have a problem with that fund. And I know they're going to want to sell it at that point. So the question is, do I continue educating them and try and push through that, or do I just not expose them to that fund? So I've got an option. And I'm very open with how I talk to them about it. So we sort of take them through that journey and say, like, listen, I know you like that fund, but if this happens, what are you going to ask me to do? Are you going to ask me to sell it? And the answer is yes. They don't answer. I know the answer is yes. Yeah. So I'll avoid that fund. Okay. So you've got to read the room as well with bonds, and I think that's critically important. The part that we always do is I've been educating advisors on bonds for 15 years. I don't think I'll ever stop educating on bonds. It's a misunderstood asset class. It's possibly the most hated asset class after 2022. But it's odd for me. I think I'm a little confused. I'm an Aussie equity investor at heart who loves bonds. So I can very much talk from a confused point of view, but I've come to love the asset class and can talk very openly about it.
So I used the word exciting, you used the word love. I'm not sure which is sadder there, but anyway, we'll take what we can get. I might turn to you now, Michael. You have the ability at Real Asset Management as the head of fixed income to go across a wide range of instruments, all the way from government bonds to investment grade to down the capital structure. I imagine that gives you a lot of opportunity, but also means that you've got to look very closely at where we are in the cycle, etc. What are you seeing at the moment, and how are you allocating your clients' money?
Hey, thanks a lot, Tim. Hopefully everyone can hear. But I guess our style is a bit different than some because we have an income-focused managed account. So obviously we're also subject to the constraints that the platforms have. So our investment universe is restricted to ASX-listed securities and ETFs, and we choose ETFs to keep the underlying costs down for the investors. And also the ETFs provide a large range of subsector exposures, and you can really pick different subsectors of that fixed income asset class, as was highlighted in the first slides. So the way we build a portfolio to generate that income is we have a diversified approach where we blend ASX-listed hybrids, which I know you don't necessarily like, with some high-quality government bond and floating rate exposure. So free time, that provides a more diversified solution for clients, and it also provides regular income for clients. And as I said at the start, we're an income-focused investment strategy.
And in terms of income, we hear when rates were down towards zero that the magic number was 4%, everyone needed. And now, of course, cash rates are at 4%. We're hearing that people need 6, 7, 8. Is there a magic number? Do you find that people are looking for an absolute return, or is it just capital preservation plus a bit?
Yeah, unfortunately, there's no magic number, so to speak. But I guess in the current environment, with the cash rate at 4.1, and once you add on the credit spreads, you're at 10 years high in income from high quality investment grade assets. So the consultants would obviously know best, but if you can get a TD at 5%, we think you need to be above that for an income style to be attractive to investors. So we're starting to think the magic number for investment grade diversified portfolios is around 6%. But there's lots of different more speculative type exposures which can get you 8 to 10%. But investors really need to make sure that they understand those risks. Because investors did chase risk in the pandemic, and they went down the quality curve to get these 4 or 5% type yields. But now, given the point in the cycle we're at, and with the outlook for a potential slowdown, it might be a good time to move back up the quality curve. Yeah,
and I guess there's a credit quality aspect. There's also the liquidity, as I think you guys referred to. So one of the things you touched on, Chris L, was the fact that a lot more retirees are coming into the system. I think the peak baby boomer retirement age was last year. So us Gen Xers, the youth of society, are still about a decade away, but you must see a lot more interest around retirement products. We keep hearing, I guess, and I'm sure everyone in the room has a view on this, that's something we all need to do, but not quite sure how to do. Fixed income clearly would be front and centre of some of those products. What are you seeing in that space? And I might start with you, Chris L.
Yeah, I mean, we've been covering the wider market for a long time, and we've seen retirement products come and go. And obviously, I mean, you got a broad spectrum there from in the simplest terms in terms of when you think about income, you think about term deposits, I mean, through to annuities, through to types of structured products on the retirement side. I mean, and ideally they're trying to achieve, I mean, either longevity or some sort of capital guarantee or capital stability of return. But my view would be that, I mean, if you cover enough of the bond market, and if you think about where bond investing was 15, 20 years ago, I mean, there's a lot of tools, as Chris mentioned, in our toolkit today. So we don't have to be very specific or quite niche about how we go about it, because there's a big range of investments we can use. And that's whether it's unlisted managed funds, whether it's ETFs, whether it's a whole range of other securities. I mean, if you cover enough of the spectrum, you've got plenty of tools at your disposal. So my view would be that we could effectively consult to you on that basis in terms of the range and give you a broad range of those. We do consider retirement products. We're not negative them or anti them, but it's more about how do they fit an advisor's toolkit. Are they usable in a core model portfolio? Are they usable outside? Does an advice firm actually value the use of them? Or is it just best to stick to traditional fixed income investing and achieve the results you've been set or the outcomes you've been set? So I don't think it's an in or out type of approach, but obviously the bedrock of most of these retirement products is either some sort of insurance contract or a fixed income type investment, and we see them time and time again.
And I guess it helps that long rates are now actually giving you a decent return. You know, even in the state government space, you can now get 5 point something for a 20-year investment, which obviously looks pretty good in the context of cash rates at 4.1. So again, it's the idea that you're getting defensiveness, you're getting protection against an economic downturn, but you're also getting rewarded in the meantime. And that's something I can tell you over 30 years, you don't always get both of those. So Chris W., in terms of what you're seeing in potential retirement space?
I think I'll probably take the lens again on the advice firm, right? So something that we've sort of learned is, and perhaps others in the room already knew this, but what you find is client bases cluster around advisors, right? So advisors build up a client base typically through their career, and they end up with a cluster of clients, and you end up with this unique characteristic, which when you come from industry fund land, or large super land, you actually don't have this benefit, right? So when you're in a large super fund, if you're one of the giants now, you're managing portfolios for an average of 1 million people. And you've got no matter how good your technology or data is on those individuals, you actually don't know their priorities and constraints. Whereas when you're in an advice firm, say you've got 6 advisors and you each have a book of 50 clients, there's 300 individual family groups that you're looking at. And often they'll be at a similar point in their life as what we found, right? Where you'll have some firms that maybe they're supporting younger business owners or something like that. And so people will be typically 40, 50, or people have been around a bit longer. Maybe they've got a specialty in, a couple of our clients are specialist retirement planners, right? That they're actually positioned, that's exactly the thing that they do. And so because of that, you actually have a competitive advantage. We can actually think holistically across your portfolio about some of those liability matching pieces. So it's not necessarily that we'll see a wave coming across all clients. It's more we're seeing these emergence of sort of firms that are very specifically focused on retirement planning versus others that are focused potentially on wealth management or supporting business owners, whatever it is. But when those firms are focused on the retirement planning, it's then to what Chris L said around, I think key to this whole discussion is as soon as you get more complex, effectively complexity needs to be priced, not just at a portfolio level, but a client interaction level, right? And I think the same is true for any retirement product, because anything sometimes has some sort of derivative underneath or some sort of risk of illiquidity when you don't want it underneath. I think I'd probably be self-reflective on us here, in our side of the table. We need to listen a lot to really understand exactly what the price of that is for the end client. So what you're seeing is starting to see annuities, but then the eyes start glazing over, all right? And so it's really, if we've been using this phrase cash as a competitor, right? For a lot of people, starting with that term deposit is probably a great starting point. Right? Why overcomplicate it and create anxiety and complexity and confusion when the role of advisor and a real value of an advisor is delivering trust and understanding? So we almost think the more complex products we put in portfolios or help clients with, we're actually sort of defeating the role that they're there to help their clients for.
And this is a question for all three of you, whoever wants to take it. We've heard the equity people say they don't really focus on the economic cycle as such because it's too hard to predict, which is a luxury not necessarily afforded a bond manager. But the question I guess I would ask is, how are you framing portfolios in fixed income in particular? And I might start with you, Michael, around the risks to the economy, because we have heard that we do have a lot of downside risks. I think everyone's aware of them, but it's probably also safe to say that I think we've all been a little bit pleasantly surprised that the Phil Lowe's narrow path to a soft landing seems to have widened a little bit during the year. It seems that we can get a fall in inflation without unemployment going up too much. Has that given you confidence in the credit products? Because credit's had a pretty good 12 months, hasn't it?
Yeah, thanks, Tim. Obviously we do focus on the macro and also focus on the outlook for cash rates, which are very important to all segments of the fixed income sectors. So obviously that's changed how we build diversified portfolios, and given that rebound in the bond yields, which when you get 4% plus, it starts to look increasingly attractive for us in a diversified portfolio context. So we've been adding exposure to that government bond exposure in our portfolios, and we do that to both achieve the objective of that regular income, but also to provide that downside should that slowdown come through next year. And obviously, we saw some charts previously, with the cash rate at 4.1, there are certainly some signs that there is a slowdown. Consumer spending's been quite weak, and the charts up from the previous panel did have the forecast cash rate, which is expected to fall from 4.1 to 3% by the end of next year, based on consensus forecasts. So in that environment, we think bonds are looking pretty attractive as part of a diversified portfolio, but at the same time, our objective is to provide that income for clients. So we're still happy to invest in that credit piece also, so we can punch out those 6% type yields that clients want.
Okay, and I guess just following on from that, fixed income, as you mentioned, you've got government bonds at 4, you've got state governments towards 5, you've got bank above 5, and if you go down to capital structure, you're looking at even 6 or 7%. Which I'm no expert on equities, but tells me that we're perhaps exceeding equity dividends now, even on a fully franked basis, something which we don't often see. Is this a cause for reallocation from equities to fixed income, or is that far too simplistic?
Yeah, I mean, probably just going back to the previous question, I think we're in a privileged position that with macro, we get to form our own macro views as consultants, but we get to hear every macro view from every fund manager in the market. So, I mean, we get thousands of macro views every quarter, and we get to distill those and then check them against our own. So, I mean, it is a privileged position from that perspective in that there's a lot thrown at us and they're constantly changing. But I think for us, it's a way of navigating through how we think about, obviously, multi-asset investing, but particularly around bonds. And it helps us sort of gauge our comfort levels around our own sort of macro forecast. So I think that's probably in response to the previous question. I mean, in terms of the stack, the corporate stack, if you like, or the return stack, in terms of how you want to refer to it, I mean, the stack's as wide as you want to take it in terms of your coverage. So, I mean, you mentioned government bonds at 4%. I mean, depending on how high you want to go, out to high yield emerging market debt, even mezzanine debt, I mean, the spread's very wide now in terms of that. But the problem with that is that you then have to price that in terms of the cycle. And that's the key criteria. So you mentioned before, there's no perfect investment return for clients, but clients obviously gravitate to a high return every day of the week. That's sort of what they're then inclined to do as human beings. But they're not very good at pricing risk. And that's because, I mean, a lot of times our job is to see risk before it happens, or try and identify risk before it happens. And the hard part for the last few years in particular was, I mean, trying to tell investors and advisors that there is risk, and the risks don't actually play out because they get patched over by governments or central banks. So you're sitting there almost, I mean, you feel like you're fear-mongering and scaremongering, and the risk doesn't play out, so you've got no proof point. So you have to use historical contexts. You have to use, we've done stuff through the last couple of years where we actually put the corporate stack on screen. And we go, this is the corporate stack, so you can actually see it from top to bottom. And these are the historical rates of returns for each part of the corporate stack, and this is where they are today. And you can get a feel for the level of risk. And I think if you do that eyes wide open, I think you can sort of navigate through that with comfort in terms of the risk you want to take and the return you want to achieve. But it is good to see, I mean, if you think about the last 15, 20 years, it's good to see we're starting with 4 at the bottom end of the stack rather than zero. So much easier paradigm to operate in from a multi-asset perspective, but particularly from a bond perspective as well.
Chris W., anything you want to add? Or you want to do questions? I thought I was the only one who got to ask questions. Excellent. I look forward to any questions from the floor then.
Maybe you touched on retirement products. It's close to my heart. I'm one of those nasty baby boomers that bought all the property, wrecked the environment, etc., etc. The obvious thing you talked about, fixed interest was seen as the thing to do. You go conservative when you're retired, and you're going to get your 4 or 5%. That's great, but the actuaries are telling us at 65, you've got 30 years life expectancy for one of you at least, probably. So how relevant is that now? I mean, should we be going into this more conservative, whether it be, all fixed interest, or should we be staying into something more risky when we're looking at retirement products?
Thank you. That's a great question. It's something like Chris talking about the slides on Stack. One of the slides we have with a lot of our partner firms is effectively the outcome of the life tables, which shows if your average client is here, this is how long at least 50% of them are expected to live. And then if you adjust for socioeconomic status, etc., often you get a skew to the right as well. So it's actually quite a long time. And so so something that you often have is what you're getting at is people underinvest in risk through retirement. Right, so they end up going completely defensive or they completely cash out. And it's actually one of the advantages of advice is that people don't, and this is what I saw in previous life, is people would get to their preservation age, they'd cash out and go to a term deposit. Right? One of the big benefits of having that retirement planning is to actually go through retirement with investment and actually staying invested. And that's where we've seen for the firms that we partner with who really focus on retirement planning, what's worked for them is more of a bucketing type approach where they deliberately have like a 10-year plus bucket or 7-year plus bucket, which is like 100% equities or 100% risk assets by default. And so they are able to segment the conversation. We've talked a few times about actually talking about the client lens here. What they actually able to do is go, okay, you've got this many years in cash in this intermediate piece of the portfolios when we're talking about these other parts of the capital structure. And at the end, they're able to take risk and actually keep those clients invested because you're able to communicate to them, okay, well, over 10 years, what's the probability of that actually being negative return? And it becomes very, very minimal, right? And so you actually link that you're not going to touch this money for this long. Here's the chance this is going to be positive and here's the evidence of it. But you know that you can, buy the kids this and spend that holiday there or your living expenses early. And it is really a simple, at its heart, really simple retirement planning strategy. But I think in our seats, we often overcomplicate things. And actually that client lens and having that simplicity of segmenting the capital in the client's head is very powerful to help them stay invested because it's actually, to your point, critical with the fortunate life expectancies we have in this country.
I think the only thing I would add, having been around this sector for a while, is the lack of focus on inflation. I think 2022 was useful for one thing, little reminder that inflation can happen. And the fact is most people live in a nominal world. They don't really sort of focus on after inflation impacts. But one of the reasons, of course, consumer spending is so weak at the moment is wages haven't kept pace with inflation. Investments haven't kept pace with inflation, and people have actually gone backwards. Now, as a society, maybe we needed that a little bit. But the point is, I would make is a lot of the money I manage is on behalf of insurance companies who actually model their liabilities and therefore actually have a lot of inflation instruments to match their liabilities. Now, they have to. They're told by regulators they have to do it. And then I go across to the world of funds and particularly with retirees, and it's one of those sort of, oh yeah, there's inflation out there, but it'll be sweet over time, right? And perhaps the conversation doesn't happen that you can actually hedge your inflation liabilities. In other words, your purchasing power today is going to remain intact. And I would have thought, I haven't reached there yet, I've got many years to go, but I would have thought that if you were in retirement, just knowing that your money's going to buy you what you need is probably the starting point for most discussions. Anything else on top is a bonus. So any other questions? Yeah.
Hi, Nick Froelich from Cognizant. I have a question around subordinated debt. I have a self-management fund. I'm actually here for my family fund. Yes. From a subordinated debt point of view, what is your point of view?
Do you want to take that one, Michael? I'm happy to. Or on the capital structure, obviously you've got senior debt, sub debt, and then you go into the world of hybrids, which I think Michael was alluding to before. People like me view as equity, but other people slip in the fixed income category. It's one of those, get out of our world, please. But anyway, but subordinated debt, yeah, look, the whole point of after the GFC was there was massive re-regulation via Basel III. It's a global thing, it's not just Australian, making sure that banks have the various levels of protection. So the way I would view it is senior debt is safe. I've actually heard a treasurer, I won't mention his name, I won't mention Wayne's surname, who told a lot of a group of overseas investors, we will never let a bank go bust, and senior debt is as good as government debt. Now, you can't quote that, it's not explicit, but in senior bank debt, we're very, very comfortable. Obviously hybrids, as people will discover when they look at the prices going up and down, there is equity-like risk in there. Sub-debt is this piece in between, which is sub to the senior, but obviously senior to the hybrids on the capital stack. It gives you a higher return. And I would actually say, in the context of the Australian banking system, is very, very safe. Tier 2 is what we call it. I think that's a great opportunity for investors who don't need liquidity, because those things in a crisis, the liquidity does disappear and spreads do get hit quite hard. But if you're one of these medium to longer term investors who can afford to sit there over the next 5 years, they give you very attractive returns and should be part of your portfolio. And I say that with a heavy heart as a government bond person, but I would encourage you also to have some government bonds, because if you do need liquidity for whatever reason, it could be something as good as the fact that equities collapse and you want to put more money into them. If the equities are collapsing, you're probably not going to be able to sell your sub-debt at any reasonable price, but you will be able to sell your government bonds at a reasonable price. And I would encourage, in the last 50 seconds, for everyone to not forget about liquidity when you're looking at these things. So thank you. Sorry, one.
Tim, sorry, I'll just add to that. I guess there's different types of sub-debt, so that's probably the most important point. If you're in sub-debt of a major bank, it's a lot safer than in sub-debt of a non-bank or non-investment grade company. So you really have to look at the quality of the company that you're investing in, and that's obviously a key part of our process.
Roxanne Gorman from Perpetual. We spend a lot of time talking and thinking about monetary policy. I'm just wondering or interested in your thoughts on fiscal policy and the impact and influences on that side of things.
Now, given we're part of the Perpetual Group now, that sounds like a planted question. I promise you it wasn't. And you've also touched upon one of my favourite topics, which normally I could rant for an hour about, but I'll give you the 2-minute version. Fiscal policy and monetary policy should be, and Phil Lowe's talked about this recently, should be like the old cars you used to have when you were learning to drive with the dual pedals and the dual controls. It should be like that, and they should be working together. They should be tapping brakes together or hitting accelerators together. During COVID, they both hit the accelerator very hard, and in Australia, they've actually both been tapping the brakes. Obviously, the RBA's been doing the heavy lifting, but we do now actually have a budget surplus, which is great in Australia. I contrast that with the US. The US initially, late last year, was undergoing fiscal repair. All the automatic stabilisers were kicking in, and then it's gone completely the other way. The US budget deficit has slipped this year from 4% of GDP to 9% of GDP. To put it in Australian terms, it would be like we were running a 100 billion deficit and we're back to 200 billion deficit. We've got about a 25 bill surplus. So in the US, that is the major reason in my mind why the US economy is having a very long cycle and is still looking reasonable shape despite everyone's predictions. In Australia, though, the government is doing the right thing. It is letting the automatic stabilisers take money out of the economy and slow things down, trying to create some excess capacity. We do have the stage 3 tax cuts, which are legislated to occur on July 1 and look like they will, which for a lot of people in this room will mean anywhere up to a $10,000 a year boost. So that'll be worth about 25 bill to the budget, so it will send it the other way a little bit. But fiscal policy and monetary policy should work together, and in a rational, stable society they do. In the US they don't. So maybe just leave it there, otherwise I could talk for too long. All right. Well, I think that's our time. I've got a flashing line. So thank you very much, everyone. Thank you for my fellow panel members.